All right, we are going to get started. So thank you guys for joining. My name is Mark LaMonica. I'm the product manager for Morningstar Premium and morningstar.com.au. First, we have to go through a couple of our housekeeping items. So number one, anything you hear today is general advice. I'm supposed to give a longer disclosure for the New Zealand Regulatory Authority, but Shani did not send it to me. But the gist is that you should contact a financial advisor if you would like any personal advice. So I think that's enough, and that you should go to our website where you can see our FAP. There we go. I did it. That being said, I would like questions, so please ask lots of questions. It'll make it more fun for me, and as I always say, that's the important part. So we've got a new series up now. So feel free to sign up for anyone's in the future, and we will get started. So today we've got a little bit of an odd topic. And it's an odd topic because Shani, who does pretty much everything, was away last week, and I had to come up with all the topics by myself. And she came back yesterday and looked at these topics and was horrified. But I think maybe this one could be interesting. Really selling this. But we're going to talk about, does a good story make a good investment? And there is a little bit of background to this. And we'll get into Bill Miller and that quote in a second. But the background is I wrote this series of articles about Bubbleville last week, and I had lots of people write in. I asked people to write in and talk about their own past experiences in bubbles, and they were talking about the different stories that they heard to justify some of the things they were doing. And that makes a lot of sense, right? Because as humans, we're all attracted to stories, and as investors, we need to understand that our ability to interpret those stories is going to have a big influence on our investing outcomes. And particularly just because stories are used by your friends, by the industry, by lots of people to try to convince you to do something. And we, of course, tell ourselves stories to try to justify our actions either before or after we take them. And what we're going to try to talk about today is the answer, I think, is most of the time a good story does not make a good investment. So we're going to try to walk through that today. And one thing before we get into this that we need to understand is, what is the market? So at the end of the day, the market and movements in the market is really just a consensus view of millions of different investors around the world. And they all may have different opinions about what's going to happen in the future, but really the average, which is the index, is going to be that consensus view. So what that does is that financial prices, prices of stocks, index values, all reflect this consensus view. And as sentiment shifts, of course, those indexes and security prices shift as well. So we're going to talk a little bit about that today. And no matter what you actually believe in, so whether you believe in the efficient market hypothesis, which means the market is always perfectly priced and the market rationally interprets new data and information and then changes prices, or if you're more on the behavioral camp, which is where I am, that believes a lot of the movements of a lot of things investors do are irrational, and particularly in the short term, they can be very irrational. Either way, whether it is rational thought or irrational actions, the market still represents this consensus view. So that's what we're going to talk about today. And the really important thing is this quote from Bill Miller, right? So 100% of the information that you know about a company represents the past, right? Everything you know is financial statements. Those are financial statements that have been issued and represent the past. But 100% of the value and what matters for companies, what's going to happen with your investment, is based on the future. So here we go. All right. So maybe people have heard this quote. I, of course, didn't attribute it to anyone because everybody says it. But when I first started investing, one of the things that I always thought was interesting is basically this Apple article right here. So this is from January, and Apple recorded record profits, and the stock, of course, went down, which I could never figure out as an investor. That I always sit there and I'd read the earnings release of a company that I owned when I was younger, and it seemed great and all the news was really good. And then, of course, the stock would go down. Now, why does this happen? Well, this, of course, happens because as investors, all we care about is the future. And what matters is not if something was good or bad, and we'll get to this point a lot, but it matters how did that compare to our expectations. So, of course, we've got this quote here, who had an trip to anyone, buy the rumor and sell the news. So that's just like an old investing adage. But yeah, it's really important because financial markets at the end of the day are looking at future events and then trying to dictate based on our prediction of the future whether we should buy or sell securities that we hold. So that's some more context to sort of put this thing around. We're going to go through a couple different examples around that. So this chart so we're looking at Vanguard Australian shares. And as you can see, we're going back to the beginning of 2020. And then I think, I went to September. So I went to the end of September. And this is, of course, this giant COVID-related drop. So everyone remembers this, hopefully. So basically what we have here, a couple dates that my poor PowerPoint skills I outlined here. So February 21st, that was the high. So not only a high for last year, but also just in general, the market's up until that point. And then, of course, on February 21st, we had this steep, very, very quick drop. So over 30%, down to March 23rd, which was the low. So this Vanguard Australian Shares Index ETF represents the ASX 200, of course, but this is sort of mirrored around the world. The dates may be a little bit off between that high and that low, but same story. And if you go back and you look at, and I went and I pulled different events that happened during last year. Obviously, I just pulled the COVID-related ones. So if we think about this date, February 21st, well, the first case in Australia, so the first COVID case for incoming travelers from China, that was on January 25th. The World Health Organization declared a public health emergency on January 30th. Market is still climbing during all these times. And so we had all these different events. So Scott Morrison declared a Australian health sector emergency on February 27th. So right as I think that stuff was happening, obviously we saw this market fall. But if we go and look at all the things that happened after March as well, when the market started climbing again, lots of different things. So this was before the Victorian lockdown. The borders were closed. The international borders were closed actually 3 days before March 20th. A state of disaster was declared in Victoria as part of that lockdown on the 2nd of August. All during this whole time, unemployment was increasing. The RBA was obviously cutting. GDP was falling. So all of these different things were happening while the market was climbing. Now, why is this? Well, of course, this is because the market is anticipating the future. So market got freaked out about COVID really before a lot of things in Australia hit. Huge fall. Then it started pricing in that recovery. So, and hopefully this will make sense in a second, but I just wanted to use a couple examples. Oh no, I can't use PowerPoint. Same thing happened. So this is the GFC. So I'm looking back at the US now. So I'm going from the end of January in 2007 until, end of Feb 2010. Same thing. So the high of the market, October 9th, 2007, right there, that low. And this was a much longer and slower fall. Obviously, you can see some of the areas where it kind of fell off the cliff. But longer and slower fall. Finished up at a low on March 9th, 2009. I won't go through all the stuff that was happening in the GFC, but what I will say is that the unemployment rate in the US kept rising. It peaked in October 2009. So once again, we still didn't know that was the peak at the time, but the markets recovered way faster than the economy recovered. And that's because, once again, they are anticipating the future and pricing in the future. So where does this all get us as investors? We're going to talk about this book, and this is, well, for me, I think one of the most influential books that I read. So it's right down there. It is The Future for Investors by Jeremy Siegel. And I really like this quote. So he says, of course, the long-term return on a stock depends not on the actual growth of earnings, but on the difference between its actual earnings growth and the growth that investors expected. So that's what we were trying to explain before, that things are all based on expectations. That's why the market recovers way earlier generally than the economy recovers. And these are obviously pretty stark examples that I used, but all that really matters is the difference between expectations and then what actually happens. So what Jeremy Siegel did in this book, so this Future for Investors, and he wrote a couple books around this same kind of theme, Stocks for the Long Run is another one. So he wrote this book in around 2003, or he used 2003 data up until 2003. He went back to 1925. And despite what some people on the team think, I was not alive then. But he goes back to 1925, and he looks at that period, 1925 to 2003, and went back and looked at all the stocks in the S&P 500 and looked at what performed the best. And as people can probably figure out, the stock that performed the best over that period was Philip Morris, which of course makes and sells cigarettes, including Marlboro. So he was very surprised by this answer. But if you go back and look at Philip Morris, this is actually pretty incredible. So over that time period, from 1925 to 2003, it had a 17% average annual return, which is like shocking. Now, this assumes that dividends are reinvested. So that basically means that when a dividend is paid, you are buying more shares instead of taking that in cash. But with dividends reinvested, if you invested $1,000 in Philip Morris in 1925, in 2003, you have $380 million. Which is crazy. That is a crazy number. And Philip Morris, over that time period, beat the S&P 500 by 7.3% a year, which is insane. Now, what I wanted to talk about a little bit in terms of expectations, and he talks about this a lot in this book, and it really changed my whole viewpoint of investing. Well, the cigarette business, if we look at 1925 to 2003, and what I got is a bunch of countries in Europe and the US, and you can see the sale of cigarettes per adult per day. So it peaked in 1961 in the US. So I'm looking at the US. So in the US, 11 cigarettes a day were sold for every adult. So 1961, but then 1961 to 2003 is a very long time period. And consumption fell, as you would expect, from 11 cigarettes per day per adult to 4.9 cigarettes a day per adult. So, and all of us that have been following anything smoking related know what happened. So obviously during this whole period, there were the first definitive links between smoking and cancer. There were all sorts of bans on advertising. In Australia, obviously, there was a ban on branding during this time period. The number of smokers dropped significantly. There were more taxes, more regulations, yet still, this is a company, not exactly in a growing industry, but a company that managed to beat every other company in the US in terms of returns. Now, why did this happen? Well, it happened because of differences, as Jeremy says, and I'll get into some examples of it, between the expectations, which were quite low. Obviously, every time more bad news came out, and this was not just one day it was declared that cancer was caused by cigarettes. There was obviously, this happened over a long time period before it was widely accepted. You got all the warnings on the cigarettes. But it's this difference between low expectations and then what the company was actually able to do. And you're probably sitting there thinking, well, a lot of things have happened since 2003, and that's true. But if we run this from 2003 on, it still was, Philip Morris still performed very, very strongly. It split in that period between Altria, which was domestic U.S. tobacco, and Philip Morris, that was international tobacco, but the stock doubled again. So if you go back and you run this number from 1925 till close to today, now your $1,000 worth of Philip Morris would be approaching $1 billion. which is insane. And Philip Morris in 1999, the dividend on a share of Philip Morris exceeded the stock's 1980 purchase price. So you're doing very well, and this is compounding at the end of the day, right? The fact that you are continually reinvesting these dividends and making money. So Lisa says, I wish you had told me about Philip Morris back in 1923. So she wanted to jump the gun a couple years, but yeah, no, I wish I would have told myself about it, since clearly I was alive in the swinging 20s. So yeah, pretty interesting. And I've got a chart. And this is just looking at it from that other period. So you can see, sort of how it performed since the period where he wrote this book. So 2003, it was up 440%. And that is not even counting the spinoffs. And it also spun off Kraft. They own Kraft as well. So you can see 440% just for, so this became Altria, the U.S. domestic part of the firm. It beat the S&P 500 that was only up 388%. So pretty interesting. And a couple lessons from this book that sort of I took away. And this is a quote that Siegel puts in his book as well. Basically what he said is it doesn't matter to an investor if he buys a firm growing at 20% if that growth is already priced into the stock. The company results are lower, say 15%, the odds are substantial that the stock will get hammered, dragging down returns. So if you bought a firm that was growing at 10%, but the market expected 5%, you would experience much better results. And the other thing, of course, that we've learned, there was a very large bang out there. Someone must have fallen over, but the clumsiest person at Morningstar is in the room, so I don't know who did that. But maybe something to do with that cart. I won't tell that story. So anyway, the other thing that of course matters is about cash flow, and how companies actually invest their cash flow. Now, just because they needed to be, Philip Morris, of course, was very, very focused on returning cash to shareholders. Part of it is because there wasn't a lot of investment opportunities for them. If you are manufacturing cigarettes and consumption of cigarettes is dropping dramatically, it's not like you're building more factories. So a lot of that cash flow was returned to investors in share buybacks and dividends. Whereas a lot of companies that are growing quickly will just keep chasing that growth. And in many cases, will make poor investment decisions. Management will make poor decisions with the money that they're actually investing. So that's another lesson. But the really, really important thing, I think, when we're looking at the market now and what I was getting from these different emails from people is that people are attracted to these stories about things that are going to happen in the market. But most of these stories, by the time you actually hear them and they become quote unquote obvious, they're already priced in, which means as an investor, you are never going to get the benefits of those stories. So something to think about. Oh, something happened. All right. And what are some of the stories that we hear all the time right now? And once again, remember, once this stuff becomes obvious, it's priced into the market. You're not going to get a good outcome. So interest rates are going to stay low forever. I mean, that's one of the biggest stories that we ever hear. And so whether people won't actually say forever, but mentally a lot of people just locked in the fact that interest rates are going to be this low for a very, very long time. Well, what is going to be the impact if there is any change? And interest rates don't have to go up to 17% for this to happen, or whatever they were back in 1980. They just have to go up because everybody expects them to stay low for the foreseeable future. So any difference in expectations, for example, in interest rates are going to probably rock the market. Same thing with inflation. Everyone's decided that inflation's dead. Any change in that expectation is going to have a very profound impact on the market. And then I've got a bunch of this other stuff that we hear all the time. So everyone should invest in electric cars and batteries because the world is going to move to electric cars and batteries. Well, I agree with that. But the fact that everyone else agrees with it means the investment opportunity probably isn't that great. Cannabis. Everyone's just going to be smoking weed all day and it's going to be legal everywhere. Well, we're already seeing that starting to pop. It just did in Canada, where they decided every Canadian was going to spend all their time going out and buying weed. Well, it didn't happen. So it was legalized. The demand didn't go back up. So there's been this huge drop in prices of a lot of cannabis shares in Canada. Of course, the one that I like to harp on: credit cards are dead, and buy now, pay later will take over. Well, all of that is baked into the stocks. So if that does not happen, the stocks are going to get hit. One for you, Will. Crypto is the future of currency. Maybe it is, maybe it isn't, but a lot of people think it is. So what happens if it is? Well, you'll probably get an average return. What happens if it isn't? Watch out below. Biotech. So biotech is going to revolutionize the way we treat diseases, probably. But once again, what have we baked in? Green energy, same thing. And yeah, this debt bubble, once again, is related to interest rates. And the other really important thing to think about during all this, with any story that you hear about investing, is who is actually going to capture the value of what happens. And it's not always companies and investors, or it's not always investors. So think about that. So we think about the value that comes out when a new product or there are giant shifts in society. We don't exactly know where it's going to go. Investors, for some reason, assume that it's always going to go to them, but a lot of times it isn't. So it can be captured by society, for example, which is beneficial to all of us, right? But it is not good for investors. It could be captured by management. So we see this a lot. What are managers out there doing? Well, they're making a bunch of money. They are selling shares. They are diluting. They're selling their own shares. They are diluting the stock by granting lots of options to all the other managers and their employees. They are capturing the value. Sometimes it's customers. So that's great. All this value is just resulting in lower prices, which is great. Sometimes it's suppliers, which is one that's always really interesting. So the big story around that is railroads. So we hear all about these this railroad mania that happened in like the 1820s in the UK. Same thing happened in the US. Everyone started railroad companies and built these lines all over the place. Well, who actually benefited from this? None of the railroads did. Most of them went out of business. Who actually benefited from were, number one, the people that were making the rail tracks and all the raw supplies that went into all of this, and then people that eventually were able to ship things very, very cheaply on railroads, because there were so many different railroads that it became cheap to ship. So you see this all the time. If you read about Rockefeller and what became Standard Oil, why did they benefit so much? Well, all of a sudden you can start producing oil in Pennsylvania, where they started, and ship it all over the country for practically nothing. Same thing for Carnegie. So what was Carnegie doing? Well, Carnegie was building, I think originally iron and then steel that was used in all the rail lines. So there's an example where the suppliers benefited, not the investors in this quote unquote revolution. And it was. It completely changed transport. It completely changed trade around different countries. It had a really profound effect on economies and society. But the railroads, the actual mechanism to unlock all of this, they were not the ones that captured any of the value. And sometimes, of course, it's a combination that's spread across all of this. So the other sort of story we hear is a good idea, and something that does actually get implemented is not necessarily something that is going to accrue to investors. All right, and I've got one more story. I'll give you one more story about this that hopefully will bring this home. And this is another historical story. So the other thing that Siegel went back and he looked at two companies in 1950. So once again, he took them from 1950 to 2003, and he took IBM and he took Standard Oil, which is basically ExxonMobil now, to go back to this Rockefeller example. So I'm going to give you two different scenarios, and you can tell me what was the better investment. Okay, IBM, at the time, a very innovative company, falling a little bit behind. So IBM, over this period, 1950 to 2003, so 53 years, a big chunk of time, they grew revenue at 12.19% per year per share. which is pretty great. They grew dividends by 9.19% per share. Earnings grew at 10.94% per share, and their sector, so the technology sector, grew at almost 15%. So it sounds like a pretty good investment, and it ultimately was. But same time, oil, so Standard Oil, what became ExxonMobil, they only grew revenue 8%. The dividend only grew 7%. Earnings only grew 7.5%. And their overall sector grew a negative 14.22%. So in both these cases, we have one sector that's going one direction, one that's going in the other direction. If we look at those individual companies, IBM grew a lot faster, every part of it, revenue, dividends, shares. So if we go back and we look at what we would actually make, $1,000 in IBM would have grown to $961,000. $1,000 in Standard Oil would have grown to $1.25 million. Why? Once again, expectations. And expectations are reflected in share prices, and expectations are reflected in valuations. And that is the problem with all of this, right? When you're reinvesting dividends, it matters what the valuation level is. All right. That was my weird story. My does stories make good shares? We've got a question. From Jill Martin. All right, so Jill says, what is the link between price and investor behavior? I.e., how do they intersect? How do valuations work when investor behavior can at times be nonsensical, like buy now, pay later? I think what Jill is trying to say is that, or I guess what Jill is asking is, valuations, of course, are the reflection of expectations at the end of the day. So if we want to see what expectations are with different shares, we don't have to turn further than valuations. And when we did this buy now, pay later segment, and we were looking at the fact that, forward multiples, Zip and Afterpay, are trading at something like 700 times earnings, the expectations are obviously extremely high on what's going to happen. And anything that doesn't meet those expectations, they could both be very, very successful companies. And that's kind of the, not that I'm out there arguing with people about this, but that's the argument with all this stuff. People keep telling me they're going to be really successful companies, and I think they probably will be. The question is, how does the company perform compared to those expectations? That is the problem. The expectations are baked into that valuation. As an investors, hey, we would all like to own Afterpay at $4, but unless you did, and you're buying it right now, then you have to look at what those expectations are and hope the company meets them. And it's hard to hit high expectations. That's why I keep expectations for myself very, very low. So if I even show up to work, people are impressed. But yeah, expectations are important. So Anthony asks, are expectations enhanced if you're a politician? Well, it depends. I guess it depends upon the politician. I feel like after Trump got elected, everyone's like, he is going to be a terrible president and do a terrible job. And then he did something normal the first day, and they're like, oh, all right, well, this is pretty good. And then, of course, he proved everyone right. But still, I think expectations in politicians are probably in general pretty low right now, which is why maybe their shocking behavior is tolerated. But anyway, there's my little political riff. I have to figure this stuff out now, because since I became a citizen relatively recently, I still have not voted in Australia because there hasn't been an election, but I need to vote for someone at some point. Okay, here's a really good question. All right, so the question is from Jack. So Jack says, could you comment on thematic ETFs that are often based on stories/investor interest? How they perform if expectations are baked into the price already. All right, so me complaining about thematic ETFs is, well, anyone who's been to these things before is pretty is pretty standard. So expectations are taken advantage of course, by people in the investment industry. And that's, in my opinion, and I think historically proven, what most of these thematic ETFs are. So everyone decides that something is going to be the next great thing. And then the marketing department of an ETF company decides that they will make an index and they will create an ETF that's related to that thematic. And the thematic, of course, always works. And I see these things all over messaging boards where people are talking about this stuff. So thematics can be batteries, right? At the end of the day, if we're all going to drive electric cars and we're going to need a lot of batteries, that makes complete sense. Once again, the question is, what are the prices people are paying for this stuff, for lithium, for every other part of the supply chain, and who's going to actually capture that value of electric cars? You talk to a lot of people, and it's not investors who they think are going to capture the value, it's society in general. But yeah, anyway, that's a really good example. So these thematic ETFs that, of course, the stories make sense and they're easy to sell because everyone believes in the stories. And frankly, the stories are probably true. But the question is, what are the expectations that are already baked in there? So that is a good question, Jack. So thank you for that. All right. We are 30 minutes in and we're out of questions. How awkward. Anyway, if there are any other questions, please send them in. We can say that this one will just be a short one, which will be good because everyone can have a break. Will had a break on Thursday for me, which must have been incredible. Although he's telling me he had to fly up to Brisbane, do a film shoot, and then fly back down in the same day. So maybe not. All right, so if anyone has any questions that come up after, you can reach me at mark.lamonica1@morningstar.com. But thank you guys for joining. Hopefully you thought this was interesting, unlike Shawnee, who thought it was a terrible topic and a terrible idea. But thank you guys for joining.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.